All right, so big ruling here that really boosts the stocks of Alphabet and Apple, two members of that Mag 7. But you're saying more broadly, not only just the Mag 7, but U.S. assets, it may be time to lower your exposure in a portfolio. Why is that right now? Why do you feel that way right now?
Yeah, I mean, it's a good point. I think this whole concept of U.S. asset dominance has been around for some time, and we've been talking about that since the beginning of the year. We know roughly half of the equity market, more than half of the equity market is in U.S. equities and half of the bond market. And we think it's a structural theme that investors need to manage that, and not just manage the equities within the market or the equity exposure, but also the currency exposure, because we still expect the dollar to weaken, so that needs to be managed. But now to your question, why talk about that right now? I think we've had an enormous resurgence of U.S. equities led by U.S. large-cap tech and a few specific companies, very concentrated rally. And it is all predicated on the Goldilocks kind of momentum that we've had since the summer. And our fear is a bit that going into the rest of the year, this Goldilocks momentum will be tougher to maintain. And to some extent, the type of places that have led the market higher probably attracted positioning, attracted bullishness, and that is then most vulnerable to a bit of a setback. So there's a longer-term element of asset allocation where you kind of want to manage U.S. asset dominance more, but there's a bit of a tactical element right now, considering the strong run those stocks have had.
Our viewers are scratching their heads right now because I think the conventional wisdom is that the weaker dollar is really good for U.S. stocks and assets because it makes it easier for multinationals to sell their goods overseas. But you're saying the dollar being weak is the issue right now. Are we reaching a critical point in the dollar slide, or is it just simply the long-term decline? I mean, why now all of a sudden? Again, I have to ask you the timing, because we've seen high valuations this year. We've certainly seen some tariff turmoil. We've seen questions about rates. We've seen questions about the economy. Why at this moment?
Yeah, no, I think you're absolutely right. The weaker dollar has actually been a core boost in the last earnings season and a big upside surprise for large cap tech. They're very international companies. And I'm not saying that this won't continue. If the weaker dollar kind of trend resumes, it will be good for the large cap tech companies. But when we talk about international investors, like outside of the US that are actually buying US equity, the drag outweighs to some extent the benefits. And I think to some extent, I would also say that this earnings season, which turned out to be one of the strongest we have seen, led by the large cap tech, was very much an upside surprise that kind of boosted large cap tech. But now it's less of an upside surprise to have a weaker dollar boost large cap tech. So in other words, these positives from the weaker currency, I think, are seemingly better reflected.
Okay. I want to go back to your article in the FT. One of the areas that you say that investors should at least consider diversifying into is Chinese tech. Now, since I imagine you did the first draft and you wrote this, we've seen some other developments specifically over in China over the last couple of days celebrating the end of World War II. And we've seen some leaders like India's prime minister kind of thumb their nose at the U.S. Also, they're there meeting with Vladimir Putin. The president's made it clear he's not very happy about that. Does that change your view on Chinese tech at all?
Yeah, I mean, geopolitical concerns, they always loom large when you invest into any emerging market, any type of place that's away from your home. And I think when you think kind of structurally, there is probably a higher hurdle rate to invest outside of your home country, if that makes sense. And that's not just the case for us investing in China. It's the same for any type of country. You need to think about which geopolitical bloc are you part of, and do you have the potential for tensions. So we try to abstract a bit from the geopolitical noise and focus on fundamentals. And you kind of want to think about geopolitical risk in the portfolio as something that you want to think about diversifying broadly, but you cannot time it, and you don't want to make it influence too much of your fundamental investment decision making. And fundamentally, I think some of these China tech companies, they're very interesting competitors, very interesting disruptors, and to some extent very cheap alternatives to US tech. And I'm not saying that they should get the same weight as US tech, and I'm not saying that they can replace US tech, but I'm saying that they can be an interesting diversifier, an interesting complement, and EM in general, because we know that EM assets tend to be negatively linked to the dollar. So if you get the dollar weakening, EM assets benefit, which then diversifies for international investors their U.S. equity exposure.
So, Christian, let me know if this is in your wheelhouse. I was talking to some traders yesterday, and a lot of them say they're seeing increased bets on the downside for the U.S. markets and also increased bets on the VIX going to the upside. Is that also a way to diversify in the options market, betting against the growth of the U.S. market? Again, that's seen a huge rally since April. I mean, it's hard to understate how big this rally's been since April, but is that also, in your mind, another way to diversify with hedging against the markets going to the downside, or also betting on the VIX going to the upside?
I think it's a good topic. I think we have September seasonality. We're all coming back to school and we have to deal with fundamentals and we have to deal with positioning. And we know September seasonality tends to be unfriendly. And yesterday was a bit of a wake-up call that this can happen faster than you think on relatively little. So to some extent, we feel that volatility is quite low. The idea of hedging is a good idea, but also you have to consider that carry trades, really since May, any type of carry trade, EM carry, volatility carry, you could even say that large cap tech in the US is a bit like a carry trade because it has recurring revenue growth. Anything that looks like carry has done phenomenally well because of that Goldilocks type regime that the market increasingly is pricing in. So now if you get shocks, they can come from growth, they can come from rates, they can come from politics, you are more vulnerable and it's easier, the hurdle rate is lower for volatility to spike and for a bit of risk off. I would say though, that we're not really that bearish. I mean, we're not expecting a very large drawdown. We're not expecting a sustained drawdown. So you don't want to overhedge as well, because I think our baseline is that recession risk is reasonably anchored. And before we have a bit more momentum on the economy to the downside, I think it's not easy to spend that much money. Okay. So we've been talking a lot about kind of option spreads, for example, rather than actually outright options.